What we're concerned about is that as interest rates in the US in particular start to tick up, that yield trade which has been, and the compression and desire to get into stocks with reasonable yields and defensive growth, or just defensive earnings, albeit maybe small, people will start to question and scrutinise that sector a little bit more strongly. So they'll say, well, what is the quality and what is the sustainability of the yield that I'm buying? And so in our quarterly, we looked at 3 stocks: Ardent Leisure, Duet, and APA, and we just looked at their cumulative cash flows over the last 9 years, and we noticed a trend where there's so much more cash going into the business than actually is being generated from the business. And when you net out all those effects and look at the capital raisings that have been done, in every instance the capital raisings have pretty much funded the dividends. Now that's okay if you're a growth company and you're really acquiring a lot of things and you're investing a lot into your business and you've got a huge amount of future free cash flows. But we just started questioning whether or not, what if these guys stopped acquiring? Would the yield that they're paying out actually start to come out of their businesses? And for the last 9 years, the cash flow statements don't suggest that that's the case. And so we're a little bit cautious that as people become more discerning about what yield really is, these types of stocks might come under a bit of pressure. And that's the real worry for us, because there are quality stocks out there which have earnings and yield backed up by sustainable business models. And then there are other stocks out there, and we saw this very much in 2006, 2007, where there was the Yield Mirage. You had your Babcock and Browns pretending that there was a whole lot of yield coming out of these wind farms and these power stations. Ostensibly good assets, but wrapped up in very poor, financially engineered balance sheets that meant that the yield was unsustainable. So you also run into that risk as gearing ratios start to creep up in some of these companies, because debt funding is so low, which then enables them to pay out a little bit more yield, maybe do an acquisition. When that yield compression stops, you're left with a company that's overgeared, that doesn't have a whole lot of cash flow to service the dividend that you thought was going to be paid out. Suddenly they're under a lot of pressure.